Good morning. It's Jeff Christian from CPM Group. It's the 2nd of July. It's about 8:40 in the Midwest, which is where I'm at. I'm not in the office this week. I'm taking care of some family matters. I wanted to talk about the markets over the last few weeks or month or so, and also about where we think it's going to go in July, August, and the rest of the year. Gold and silver have been trading in narrow ranges. Gold has held within that 1770, 1800 range. It was testing 1770 a couple days ago. It was testing 1790 earlier today. We think it may continue in that range for a few more days, but there is an increased potential for volatility. Silver similarly has been trading in a narrow range over the course of June. It hasn't had the capacity. It did fall sharply into a range of say $26 to $27, and it has continued to trade pretty much in that kind of narrow range. Both of them remain vulnerable to a downward spike. There is decreased economic concerns in some parts of the financial markets, and there have been increased attractiveness of competitive assets. And there are technical patterns that have suggested to any number of people who are short-term investors and traders that the price of gold could spike down, break below that 1770 and fall sharply. And silver similarly could break below $26 and fall sharply, at least briefly. We still think that the prices also have the upside, the possible to move significantly upside over the course of July into early August. So it wouldn't be surprising to CPM Group that we say the price both break below these recent ranges, fall sharply, and then rebound and actually break above these narrow ranges all within the next month. So the potential for increased price volatility for gold and silver in July into early August is there. Our expectations continue to be that August, September may see quieter markets and weaker prices, followed by stronger prices, maybe starting as early as September and going into December. That's our market view. If you look at the last couple trading days, the last week, the last several months, it's interesting. Basil III has come, it's arrived, and the markets didn't collapse as we expected, but as a lot of fear mongers have been suggesting would be the case. The bullion banks are still in the bullion banking business. They haven't gone bankrupt. They can still operate in a profitable way, even under the guidelines of Basil III, which they've pretty much adjusted to months ago. The COMEX July silver delivery period has now begun, and there were about 3,900 contracts delivered in the first 1 or 2 trading days. Most of them were taken delivery of by JP Morgan for its clients. It's business as usual. We haven't seen the $100 silver price by the summer that we were promised by certain people observing this market. We haven't seen a silver squeeze the market. COMEX August gold futures, we have 34.9 million ounces of open interest in the August contract. That will need to be bought back and rolled forward between now and early August. And we'll see that. And 34.9 million ounces sounds large, but if you look at the open interest of a nearby active contract a month prior to the first delivery date, it's kind of within, if not kind of low, compared to some recent levels. So it could cause some price increase, but probably not as sharp of an increase as we saw in 2019 and in 2020 in July of those years as the August COMEX contract was rolled forward. Now, I want to talk a little bit about gold and the Dow Jones Industrial Average. And I put here relationships that do not exist. We started doing these videos weekly about 8 months ago or so. And a couple of months ago, I said, I think that what I'd like to do is have a slide or two every week that is a myth buster. What's something that people say about gold or silver or platinum group metals that just doesn't hold up to scrutiny? And a few weeks ago, we did a piece on central bank gold activity and what was going on in the central banks. And that was sort of a test of it. We pulled together this chart at the same time, thinking that we would use it at some point. You will hear people say, well, we think that the gold Dow Jones ratio is going to go back to 1-to-1. And it's really hard for it to do because it's never really been there. It came close to it in early 1980, but it never quite got there. Now, this chart, which we pulled off the internet, is just really fascinating, and it speaks to a lot of the subjects that we've been talking about on these videos. The Dow Jones Industrial Average was created in May of 1896. But if you don't know that, you can go to the internet, and one of the first links you see in Google shows you this chart taking the Dow back to 1792. And 1896 is right about here, where there's a steep increase. And that steep increase represents the fact that the Dow didn't actually exist before 1896. And what people are using is the New York Stock Exchange average, which was created, well, the New York Stock Exchange started business in 1792. So all of that stuff prior to 1896 is kind of not relevant. And it's not the Dow Jones because it was the New York Stock Exchange, whereas the Dow Jones Industrial Average is a limited number of high capital companies. But the point here is that there are people who keep telling investors, hey, gold Dow is going to 1-to-1. That means either that the Dow is going to have to fall 99%, or gold's going to have to rise 5,000% or whatever the number is to get from 1790 to whatever the Dow is. And it's just not a relevant thing.